Good day, everyone. For this particular day, we are going to discuss about variable costing and absorption costing. So prior to the differences of the two methods of costing, we'll have to focus first with the concepts about variable costing. So you can see here time, because we're talking here about a particular accounting period, the cost involved, and the quality of the products that are being talked about. So quality is very important, of course, in a manufacturing environment and global scale. So this is the discussion for variable costing, which is a tool for management. So we have to take note that variable costing is a costing approach that is allowed for managerial accounting purposes, meaning for internal management. This is not allowed, this is different from the method that is called absorption costing under our financial accounting or financial reporting standards or concepts. Okay, so we have to take note that as an overview, we have two types of costs, whether that's absorption or variable. We call these two as product and period. Before I go to variable, allow me to have a review of absorption costing, which is actually discussed or tackled in a lot of cost accounting subjects already that you've had in your other subjects. So if we say product costs, these are the manufacturing costs that we have known of. So remember the three major groups: direct materials, direct labor, and the manufacturing or production or factory overhead. So we can subdivide further this particular overhead into two. Again, manufacturing or production or factory overhead into variable and fixed to make it four overall. However, we can just say that there are three major costs anyway for the product. And then remember also a review of these two. If we combine direct materials and direct labor, we call that the prime costs. While if we combine the direct labor and the manufacturing overhead, we call such as conversion costs. All right. So these are our product costs, which are the costs needed in order for us to produce the product. And then we also have the period costs. So the period costs are the costs which will benefit only one accounting period, and once they're spent, they're forever spent. So we have selling actually and administrative. Those are the two major classifications. Although if we have to go deeper with financial accounting, there could be other expenses, but then we can just simplify into selling and administrative. And then in order for us to be able to study properly, then we are going to treat this similarly to manufacturing overhead, in which we will segregate into the variable and fixed components. So the segregation of any cost or expense into variable and fixed is aligned with the concept under cost behavior, wherein certain costs will be changing depending on production, and certain costs will be fixed even if production has changed already. So these are variable and fixed costs respectively. Now that's absorption costing. On another hand, for variable costing, same definition, same concept. It's just that the difference lies on the fixed manufacturing overhead. If you can notice, the fixed manufacturing overhead is treated as a product cost in absorption costing, but it is a period cost under variable costing. So under variable costing, the only product costs are the cost to produce the product, which would change depending on the production proportionately, or let's just say directly. So when the production would increase, the cost would also would increase in total. And these are the direct materials, direct labor, and the variable manufacturing overhead. So that's how it is. Again, they would differ only on the fixed manufacturing overhead. Now, for quick check. So if I will ask you this question, and then of course the answer will be revealed later on, we'll have a pause for you to be able to think, which method will produce the highest values for work in process and finished goods inventory? So we are talking here about the total cost, in which we multiply the unit cost by the number of units produced. So do we have absorption costing, variable costing, or the same for the two, or it depends? Is now the time that you're going to answer. Make your answer. 3, 2, 1. Okay. And the answer is absorption costing, because remember again on the graph shown a while ago, the total product cost for absorption costing includes fixed manufacturing overhead, but for the variable, it will exclude that. Okay, so to continue, we have the unit cost computations. For Harvey Company, it produces a single product with the following information available. So you have here, number of units produced annually, 25,000, and these are the variable costs per unit, and these are the fixed costs per year. So this is normally the illustration wherein the variable costs are expressed per unit, and the fixed costs are to be expressed as a whole, like total annual. Now, this would be the unit product cost, which is determined as follows. So you have here the unit product cost composed of the variable and the fixed. So for the variable, this is going to be 0 under variable costing, and you can observe that the difference lies on the fixed manufacturing overhead at 6 pesos. The fixed manufacturing overhead, by the way, is given, and the units is also given, units of production. Always take note that to compute the fixed manufacturing overhead, the production cost, our basis would be the production. All right. Then selling and administrative expenses are always treated as period expenses and deducted from, for a while, I'm going to minimize this. You cannot see, from revenue as incurred. Yeah, so they are expenses to get profit or loss. That would be revenues or income minus expenses. So selling and administrative expenses, whether variable or fixed, will be treated as always period expenses. And by the way, period expenses are expenses that would benefit only one accounting period, hence period. They are non-inventoriable costs. Okay, so income comparison. Let's assume that the following information, additional by the way for Harvey Company. A while ago, we had 25,000 units produced, but we sold only 20,000 out of that at a price of $30 each. Therefore, by then, we can just realize that there is 5,000 units ending inventory, but there's no units in beginning. Now, let's compute the net operating income using both costing methods. So under absorption costing, of course, you know these formulas, I do hope. So sales less cost of sales, in which the cost of sales would be the amount of units sold, that is 20,000, multiplied by the production cost per unit, that includes overhead. So that is 16. Remember, 10 for the variable because of the 6 manufacturing overhead. So you get gross margin less all expenses for selling and administrative, whether variable or fixed. So we get net operating income of 120,000. So this is our computation, of course, from financial accounting and reporting. Now, what about under variable costing? So for variable costing, we have here, of course, differences in which our presentation would be sales less variable costs and expenses would be the contribution margin. You can actually realize this one, that under absorption costing, we have the gross margin, which is the difference between sales and cost of sales. On another hand, for variable costing, that sales less variable costs and expenses would equate to contribution margin. So we have here 340,000. And if we deduct the fixed expenses, in which the manufacturing overhead here as a total would be expensed, and the selling administrative expenses, which are of course the fixed, the remaining will be parts. So we have here the net operating income at 90,000. So let's go back. Under absorption, we have 120,000, and we have for variable costing of 90,000. So the difference, of course, is because of the treatment of the fixed manufacturing costs. So we can see on this illustration that we have the absorption costing, the cost of goods sold, and then the variable costing, this is the cost of goods sold. While the ending inventory, this would be the amount, or these would be the amounts. Well, for the cost of goods sold under absorption, we use 16,000 times 20,000. This is the value. For the variable that's 10 only, we exclude the fixed manufacturing cost of 6. That's 200,000. For the ending inventory, so that also explains. So we had like 25,000 units produced and sold 20,000. So 5,000 units in the ending inventory. 5,000 multiplied by 16 pesos or dollars, that's 80,000. Then 5,000 times 10, it's 50,000. And the period expense here would be as shown, that is 0. So no more, no further. But here for the fixed manufacturing cost, that would be the entire value, because under variable costing, the fixed manufacturing cost will be expense in its entirely or entirety rather. But then for absorption costing, that would be 120,000 and then segregated with the 30,000 to equate to $150,000. So we can notice that the 150,000 is segregated again into the cost of goods sold and ending inventory under absorption costing. However, that is treated entirely as an expense under variable costing. Okay, so the difference of the two, actually, if we go back, I just have like a quick look. The net operating income is 120,000. And by the way, that's absorption costing, while variable costing is 90,000. So there's a difference of $30,000 in which absorption costing is greater, because the reason for that is that when absorption costing units produced would be higher than the variable costing units sold or sales or production for the former versus the sales, then it would result for the absorption costing net income or profit to be higher than the variable costing. So in this case, it is higher. It is the absorption costing higher by 30,000, which is the fixed manufacturing cost attributable to the ending inventory. Again, that's 25,000 production, higher than 20,000 sales. So that's 5,000 units multiplied by the fixed manufacturing cost at 6 pesos. So that would equate 5,000 times 6, that's 30,000 pesos or dollars. It's dollars here. Okay, so this is what I've said. We can reconcile the difference between the absorption and variable costing income respectively because of or by the fixed manufacturing overhead costs, which are deferred in the inventory. So 5,000 units times the $6 per unit. So we have here 90,000 for variable. We add, so we get the absorption, or we can do the reverse. So absorption is 120,000. And because the production is higher than variable, meaning the sales, so we have to make sure that the variable costing net income is lower by it. So how lower is it, or for how much? That is the number of units in the ending multiplied by the fixed manufacturing overhead cost. So 120,000 minus 30,000 is 90,000. I'm also doing the reverse analysis than just this one. We can also say that since variable costing sales versus the absorption costings production is lower, so lower in that sense, this simply means that the absorption costing, of course, must be higher than the variable with the amount of the fixed manufacturing overhead costs deferred in inventory, ending inventory to be more specific. All right. This is also an extended comparison. We have income data for Harvey Company in year 2. Still produced 25,000, but the unit sold is 30,000. By this one, we would expect, guys, that the variable costing would be higher. But then, because there is a 5,000 units in the beginning, so remember, units in the beginning plus the units produced equals total of 30,000. And then number of units sold 30,000. So it appears that we don't have ending inventory. Let's check. Sales price, okay, 30, same. Variable costs per unit. So we have here same as given. And unit cost computations are the same. we have to take note that since there was no change in the variable cost per unit, total fixed cost or the number of units produced, the unit cost remain unchanged. Yeah. So this is an assumption though, and this is based on that particular problem. Actually, variable cost would not change per unit. What would change here probably is that if the production would change, so the fixed manufacturing overhead per unit would also change. So this is the thing in accounting. If there has been no mention about any change or any provision to the contrary, we just simply assume that the same is true. Okay, so absorption costing now, we have, as said a while ago, no ending inventory units. So we have 30,000 units sold times 16, that's 480,000. 30 minus 16 actually is $14. That's our gross margin. 30,000 times 14, that's 420,000. And deduct all selling and administrative expenses, whether variable or fixed. So we get net operating income of 230,000. Then what about for variable costing? So for the variable costing, well, for variable expenses again, that would be including the variable selling and administrative expenses to get the contribution margin. All manufacturing overhead should be expensed. We can notice that the net operating income is 260,000 higher than the absorption by how much? That was how much? 230,000 absorption costing lower by 30,000 with a 260,000 variable costing. Anyway, the explanation of this one probably is that it is attributable again with the difference between our number of units produced and the number of units sold. Should we go back to the given items, remember that we only produced 25,000, but we sold 30,000, of course, because of the beginning. So by this one, the difference would result to the differences of the income to be presented under the two methods. And this time, the number of units sold, meaning sales, exceeded the number of units produced production. Therefore, the variable costing income would be greater by 30,000. So that's the 5,000 difference multiplied by the manufacturing overhead cost per unit. So 5,000 times 6, that's 30,000. So it's here. That's how we got, again, our reconciliation and comparison of the two. So we can notice that the variable costing is greater now with absorption, with higher sales. Okay. And then here is our income comparison. And this would also tell us that in latter years, depending on, of course, the situation of the company, there would be a point wherein the two methods would result to equal income overall. Because whatever is the deferred amount of the fixed manufacturing overhead or cost in the ending inventory in the previous period will be part or will be closed in the next period. So it's like a counterbalancing effect. And therefore, that would result in total now that the 2 years total income under the two methods would be equal. Okay, so this is now our summary. If production is greater than sales, this means that there would be unsold units. And this would mean also that our absorption income would be greater than variable because production is into absorption while sales is into variable. On the other hand, if the reverse is true, production is less than sales, so inventory would, of course, decrease or inventory decreases. In this case, sales is greater than production, therefore variable is greater than production or absorption income. So we would say that absorption is less than variable income or variable is greater than absorption income. What about if the two would be equal? So in that case, no change. And absorption income is equal to variable, which is somewhat seldom and very, very seldom to occur, I would say. Why did I say very, very? Because in real life, it is really close to being impossible that what we produce is what we sell. And that is just an assumption for management accounting. All right, so that is the end of part one. Make sure to watch out and stay tuned for the next part of this series, that is part two for variable costing. Thank you very much for listening, and God bless.